Hello, everyone. I'm glad that you could join us. Today, we will cover Tax Cuts and Jobs Act, which was passed in December of last year. We will focus on changes in domestic part of the tax law. This webinar is for educational purpose only. To apply the tax provisions in this webinar to your specific tax situation, please discuss with your tax preparer. You could send your question throughout the webinar via chat, which is found at the bottom of your screen. I will try to address them at the end of the webinar, but if you want me to address your questions now instead of at the end of the webinar, you may also raise your hand, which is also found at the bottom of your screen. So why this webinar and why this year? We have received a lot of calls from our clients about tax law changes. A lot of clients are making appointments earlier than last year. So clearly, many of our clients are concerned. Tax Cuts and Jobs Act, also known as Tax Reform or TCJA in acronym, is a major change in tax law. Hopefully this webinar will answer many of your questions and may find it to be financially beneficial to you. H.R. 1 Public Law number 115-97 was signed into law on December 22nd, 2017. It is a first major overhaul of U.S. tax system in 30 years. The last one being in 1986, when I was just starting out my CPA career. Tax Cuts and Jobs Act appears to lower taxes for most taxpayers, especially for C corporations and small businesses. Due to tax benefits provided in the tax reform, the federal government is expected to have $1.5 trillion in deficit in revenue over the next 10 years. It is mind-boggling to see U.S. government adding another $1.5 trillion deficit to already high deficit of $20 trillion. But it appears that there is a rationale behind this. Most of our clients are small business owners who operate their businesses and are actively involved in the day-to-day management. Another term for small business is a closely held business, where family members are actively involved with the business. According to the tax reform, a small business is a business with less than $25 million in annual gross receipts. As such, we divided the tax reform into three broad categories of topics. Individual tax reform, which is expected to cost federal government $1.1 trillion in lost revenue. Now, if the federal government is losing money, somebody is standing to gain, and that's U.S. taxpayers. We also put the second category as business tax reform, and that would cost U.S. government $400 billion over the next 10 years. And lastly, the international tax reform, which will generate modest revenue, and we will cover this topic in another webinar. As I have said, the revenue loss to U.S. government means more money to the U.S. taxpayers. So let's take a look at what this means to you. Throughout this webinar, we'll be referring to Tax Foundation. Tax Foundation is a nonprofit organization based in Washington, D.C., providing analysis of tax policies since 1937. Their analyses are widely quoted in media, and over the years, I have come to trust Tax Foundation as a reliable source in analyzing tax policies. According to Tax Foundation, the tax reform would increase gross domestic products, or GDP, which is a monetary measure of the market value of all final goods and service produced in a period, by 2.86% over the current baseline forecast. Baseline forecast is a projection of growth of GDP without tax reform over the next 10 years. And it's an average of 0.29% per year of growth in GDP over the next 10 years. You may not think that 0.29% is significant, but when applied to the size of US economy, it is significant. According to Tax Foundation, 0.29% growth in GDP means increase in total GDP of $5 trillion over the next decade, while exceeding the revenue loss. The expected revenue loss from the tax reform is projected to be $1.5 trillion in the first 10 years. And that's over 10 years with no increase outside that window. And this is important, as we will get to see later. And according to my observation, it appears that the tax reform will force federal government to shrink in size in the next 10 years while growing the economy, which appears to be the goal of Republicans. Here we have a bar graph from Tax Foundation. It shows increase in annual rate of economic growth under the tax reform, referred to as dynamic projections, contrasting it to economic growth without tax reform, which is referred to as baseline. As you can see in 2018, dynamic projection is higher than baseline by 0.44%. That's 2.45% less 2.01%. That relationship continues until 2025. And then the relationship reverses. And I have added an arrow with a note, sunsets January 1st, 2026 to the Tax Foundation bar graph. And this is important, as I will be explaining it to you later. The tax reform, when it was being passed through the Congress, had a math problem. The Republicans needed supermajority or 60 votes to get the tax reform passed. However, they only had 51 votes. Personally, I did not think the Republican tax bill would get passed. As such, I didn't spend much time analyzing the tax bill until December. And like many tax professionals, I was caught off guard. As the bill moved very quickly through the Senate in December, all tax professionals, including myself, were scrambling to catch up to the tax reform changes to determine how it will impact their clients. After recently failing to pass Obamacare repeal, the Republicans in Congress had to push through the tax reform bill using budget reconciliation process with only 51 votes in the Senate. To bypass the Democrats altogether, the Republicans needed to tie the tax reform to the budget through budget reconciliation process. It is the process President Bill Clinton used to pass welfare reform in 1996, and President George W. Bush used to pass tax cuts in 2001 and 2003. It is also how President Barack Obama got several budgetary amendments to the Affordable Care Act passed. And that's why we have some temporary provision that pursued aggressive tax cuts, and some permanent ones which comply to the Senate rules. and bipartisan proposal needing 60 votes, they would likely find consensus around such issues as child tax credit and doubling the standard deduction. By doing so, the Republicans were able to comply with the condition of a budget reconciliation process called Byrd Rule, which required that any proposed change in law cannot increase the federal deficit beyond 10 years. By having many provisions sunset on January 1st, 2026, the Republicans were able to comply with the Byrd Rule and thus were able to pass the tax reform through the budget reconciliation process without Democrats' help. Before the tax reform was signed into law, Tax Foundation had published its analysis of tax reform around November 2017. In its analysis, Tax Foundation looked at change in tax liabilities of 8 different taxpayers at different income level. And as good CPAs, we wanted to validate the findings of Tax Foundation. So we analyzed 21 of our clients at 5 different income levels. Both Tax Foundations and our analysis looked at change in tax liability between 2017, which was before the tax reform, and 2018, which is after tax reform. Here we have the table from Tax Foundation, which was published back in November, where 8 taxpayers of a different income level were analyzed on how they came out under the 2017 tax law versus after the tax reform or under 2018 tax law. And I explained to you that this table was published by Tax Foundation in November 2017, before the tax reform was signed into law. As such, when the table refers to current law, it means 2017 tax law. Where it says proposed tax, it means 2018 law. So let's look at the Tax Foundation's findings. James is single. His annual income is $30,000, and he contributes $2,600 to his retirement account, and he has no children, and he takes a standard deduction. Under the 2017 tax law, his tax liability will be $4,331, and that decreases to 2018 tax law, which is $3,953. That's a $379 decrease in tax liability, or 9% decrease in tax liability. And the decrease in tax liability is going to be important because that's how we're going to compare Tax Foundation's table versus our findings of 21 of our clients. So James had 9% decrease in tax liability, and his income level was $30,000. Jason is single. He has 2 children, so that would make him head of a household. He contributes $4,000 to his retirement account on an annual income of $52,000, and he takes standard deduction. He would see $1,892 tax decrease comparing 2017 tax law versus 2018 tax law. That translates into 36% decrease in tax liabilities. Third case is Amber. She makes $75,000 a year. She's single, no kids. She contributes $5,500 to her retirement account, and she takes standard deduction. Her tax liability will go down by $1,777. That's 11% decrease in tax liability. Kavya and Nick are the fourth case. They are married. Their income is $85,000 a year. Only one of them is working, and they have 2 kids. They put they contributed $5,500 to the retirement account, and they take standard deduction. They would see $2,254 decrease in tax liability, comparing 2017 tax law versus 2018 tax law, or 20% decrease in tax liability. Now, something to note about CAVIA and NIC. CAVIA and NIC would represent the average U.S. household because the average U.S. household income is around $80,000. Another thing to note about CAVIA and NIC is that they take standard deduction, like the cases before them. And approximately 70% of U.S. taxpayers take standard deduction. Only 30% itemize. Although the vast majority of our clients and the clients to most tax professionals itemize, that's only 30% of U.S. taxpayers. Something to note about this 85,000 cutoff is that 16% of U.S. taxpayers are over $100,000 in annual income, but they pay 80% of federal income taxes. So up to this point, we're probably looking at 84% of U.S. taxpayers. However, people who are above this line, they pay 80% of federal income tax liabilities or federal income taxes. So let's take a look at the next level, which is Sophie and Chad. I have one question, just a minute. So the question is, does analysis for those in higher brackets which itemize include loss of SALT deduction? Yes. Thank you, Chris. I'm glad you have joined us, and that's a good question. We did analyze the disallowance of the state and local tax deduction, and that's limited to $10,000 starting 2018, and that has been incorporated in our analysis. Our analysis was done back in January before the softwares came out, so we did it by hand. So we're comparing our analysis versus Tax Foundation, which the analysis came out in November of last year. So let's take a look at the Sophie and Chad, okay? They make $165,000 a year. They're married. Both of them are working with 2 children. And they contribute $20,000 to the retirement account, and they itemize. And we were discussing that only 30% of the U.S. taxpayers itemize, and they're one of the 30%. Their tax liability would go down to $2,224, or 8% decrease in tax liability. Soren and Linnea, they're the next income level of $325,000 a year. They are married. Both of them are working with 3 children. They contribute $37,000 to their retirement account, and they itemize. Their tax liability will go down by 13%. Laura and Seth would be the high income earners. They're married. Only one of them is working, 2 children, and contributes $18,500 to the retirement account, and they itemize. They would see 3% decrease in tax liability. So this, I'm sorry, we have one more case, which is Joe and Ethan. They're retired and married, no children, nothing contributed to the retirement account, and they take standard deduction, which is the case for most retired couples, because they would have their house paid off. They don't have a mortgage payment, so usually they're better off with a standard deduction. And according to Tax Foundation, they would see 8% decrease in tax liability, comparing 2017 tax law versus 2018 tax law. So according to Tax Foundation, everyone of all income level is getting a tax liability decrease, which is a great thing. But it does make sense, because if the government takes in $1.5 trillion less, that just means it's more money in the hands of the U.S. taxpayers. We have one more question. Okay, I'm looking at the next question here. Okay, I did answer that question. Okay. So let's compare that with our analysis, and let's go to our findings. So the way we have analyzed, and we did this independently, and I just wanted to see what the tax implication is for different levels of taxpayers. And then after we have done this analysis, I have found Tax Foundation's table, which so we came to the same conclusion independently, but when I compared them, our findings were very consistent. Something to note is that the way we selected the client is not statistical sampling. Also, our sample does not represent true population of U.S. taxpayers, and so we just discussed the fact that only 30% of the U.S. taxpayers itemize, and the majority of our clients do itemize. So it's definitely not a true population of U.S. taxpayers. Also, our analysis, we're just looking at the tax rate changes, the standard deduction, and changes in itemized deduction, without considering pass-through business income deduction, enhanced cost recovery, and small business reforms. All those are benefits to the businesses, but we didn't take that into consideration because we just want to keep it as simple as possible. So we had 5 income level, which is $0 to $100,000, and we analyzed 5 clients. $100,001 to $200,000, that's 4 clients. $200,001 to $300,000, we had 4 clients. $300,001 to $500,000, that's 4 clients. $500,001 to $2 million, and we analyzed 4 clients in that income level. So this is a first level of income, which is 0 to 100,000. We saw the example of James, Jason, Amber, and Kavi, and Nick, and Joe and Ethan. They're the retired couple. And so the average of those 5 cases that Tax Foundations looked at was decrease of tax liability of 17%. Now, we came up with our own analysis independently of the Tax Foundation, and we came out to 17% decrease also. So looks like our findings are consistent with the Tax Foundation's findings. The next level is $100,001 to $200,000. The Tax Foundation decrease in tax liability was 8%, and that's Sophie and Chad. Our analysis of 4 clients came out to be 7% decrease in tax liability. Again, consistent with the findings of Tax Foundation. Next level is $200,001 to $300,000. Tax Foundation didn't have any analysis, and we did this analysis independent of Tax Foundation. So we had 4 clients in that category, and we had seen 7% decrease in tax liability, which is consistent to the $100,001 to $200,000, which is 7%, and Tax Foundation had 8% change. So the next level is $300,001 to $500,000. And Sophie and Linnea, they saw 13% decrease in tax liability. In our clients, we analyzed 4 of them. We had average of 12% decrease in tax liability. And it was mixed. I mean, we had 3 clients who had a decrease, and we had 1 client with an increase of 4%. So the average is 12, which is consistent to what Soren and Linnea had shown. So the next level is $500,001 to $2 million. And so that was the case of Laura and Seth. They had a 3% decrease in tax liability. We saw 4% decrease in tax liability among our 4 clients. And the results were mixed, but the average is minus 4%, decrease 4%. So two clients we had a decrease of 13% and 6%. On two clients, we had an increase of 1% and 3%. So the average is decrease of 4%. But that seems to be consistent with the Tax Foundation's findings. So we agree with the Tax Foundation's table that says we would see a tax decrease for all taxpayers, for all income level, under the tax reform. So we select the provisions of tax reform which is most applicable to our clients. And most of our clients are closely held businesses. And so we were looking at, from their perspective, what would be most applicable to these taxpayers. Let me see if I can go back to the previous. Well, let me go back to this one. Well, I guess I'm having problem going back to that slide. So we were talking about the individual provision generating $1.1 trillion of revenue shortfall for the federal government. That translates into $1.1 trillion into taxpayers' hand. Let's take a look at the significant provisions that would give you part of that $1.1 trillion over the next 10 years. The first one is decrease in tax liability. And as we will see in a detailed discussion later, income tax rates have all come down, except for the two rates. And the brackets, which is the bracket means income level where a specific tax rates would begin, has moved up. So a combination of rates going down, excuse me, with brackets moving up, most taxpayers are benefiting from the tax reform. And that's a good thing up to 2025. And we discussed why 2025 is important. The standard deduction has almost doubled, not quite double, but almost double. And that's a good thing. So both these two items are good to taxpayers. And they are both set to sunset on January 1st, 2026. Okay, the next is the personal exemption. Personal exemption has gone away. So they've given two benefits and taken away one benefit. I guess they had to do this to balance the budget or to minimize the loss or the deficit for the next 10 years. Child tax credit is a good thing. It has doubled. It used to be $1,000. It's now $2,000. And the phase-out level, as you can see, as you will get to see later, has gone up. So more people will be able to take child tax credit on a going forward basis. $529 plan was used in the past to fund colleges and university. Starting 2018, 529 plans can be used to pay elementary and secondary school tuitions. And that's a great benefit for parents sending their children to private school, including elementary to high school. So that's a good thing. Overall, itemized deduction, PEAS limitation, that has been suspended until 2026. And what PEAS limitation have done in the past is that for high income taxpayers, up to 20% of itemized deduction was disallowed. And so that limitation has been suspended until 2026. So that is a good thing. Reduction of mortgage and home equity loan limit and interest deduction. So in 2017, interest related to acquisition mortgage up to $1 million and up to $100,000 in home equity loan was deductible. Starting 2018, on new acquisition mortgage of $1 million has been decreased to $750,000, and interest related to home equity loan is no longer deductible. And that's a bad thing for taxpayers. State and local taxes. This has received a lot of publicity toward the end of last year. Many clients were calling asking on whether they should prepay their property tax or state income tax. On some, it made sense to prepay. On others, it did not. If you are in alternative minimum tax position, AMT for short, then it made sense to prepay your state and local taxes, including property taxes. This made sense because starting 2018, the limitation on combined total for state and local taxes is $10,000. The Congress thought that $10,000 limit was adequate since the average U.S. taxpayer had $12,000 of combined total for state and local taxes. However, in Southern California, that total is much higher. So if you didn't pay your state and local taxes, and your state and local tax is more than $10,000, then you stand to lose the amount that you paid above $10,000 as a deduction. However, in 2017, there is no such limit. As such, otherwise non-deductible taxes in 2018 could be deducted in 2017 if they are prepaid in 2017. However, if you are in AMT position, then it does not matter because even if you prepay state and local taxes, since you weren't allowed state and local tax deduction under AMT, it didn't make any difference. On those clients, we have advised them not to prepay state and local taxes. And this is a bad thing for taxpayers up to 2025. Charitable contribution limit has moved up to 60% of AGI from 50% in 2017, which is a good thing for taxpayers up to 2025. Medical expense deduction is deductible if over 10% of AGI in 2017. The senior citizens have a lower limit, but for most taxpayers, it was 10%. This has been reduced to 7.5% of AGI in 2018 to 2025. So that's a bad. That's a good thing for taxpayers. Alimony payment will no longer be deductible starting 2019. That's 19, not 18, on newly signed divorce or separation agreement, with corresponding alimony received not being income. And this is neutral for most people unless you're getting divorced or separated in 2019. So if your ex, whom you have been paying alimony, calls in 2018 asking to change the divorce agreement, you know the reason why, so you need to consider not getting that alimony deduction if you change that agreement. Moving expenses in the past were deductible. If you started a new job, which is 50 miles away from your old home to old work, even if you didn't itemize, starting in 2018, no moving expenses can be deducted, and that's a bad thing for taxpayers. Miscellaneous itemized deduction, and these are expenses incurred to generate or collect income. So these are things such as tax return preparation fees, investment advisor fees, and for a lot of the first responders, they have a lot of expenses that they have to incur related to their employment. So these are unreimbursed um, employee business expenses. They were deductible if over 2% of AGI. Starting 2018 to 2025, no miscellaneous itemized deductions are deductible. Something to keep in mind about miscellaneous itemized deduction is that this is one thing that the IRS love to audit. And so the IRS likes this because now they would reduce the audit that they have to do in this area. So that frees up the IRS to audit other areas of tax returns. So more people have to have to be more careful in doing the tax return because the audits would actually increase because they would not be focusing on this item. Exclusions for qualified moving expenses were excluded from employee income if it is qualified moving expenses. Starting 2018, that reimbursement that you get from your employer is now income to the employee, and that's a bad thing. Elimination of minimum essential coverage penalty. Most people think that Obamacare penalty has gone away. Not so. There still is a penalty for 2017 and 2018. Starting 2019, the penalty amount is zero, although the law is still there. So we need to see what's going to happen with that. But currently, the penalty is set to zero. Estate and gift taxes, good, sort of. Everyone has up to 5.49 million in lifetime exemption from estate and gift taxes, and that's in 2017. So most people are not subject to estate and gift tax because of this 5.49 million. If you have a couple, we're looking at $11 million that you can exclude, close to 11. And that lifetime exemption amount has increased to $11.2 million starting 2018. But it reverts back to 5 million indexed for inflation in 2026. So this sunsets, which makes it difficult to plan because I don't know about you, but I cannot predict when I'm going to die. So planning with something that sunsets, the state taxes, you really can't use that. However, if your estate is above that 11.2 million, then you can gift during that period as much as you can to lower or to decrease the size of your estate. So I think that's good for those people. But there's also talk about getting rid of the step up in basis. So people when they die and they give their estate to the beneficiaries received the assets at stepped up value, meaning that the cost to the beneficiaries is going to be fair market value on the date of death. That's a great thing because if you had appreciated the assets and you're giving those to the beneficiaries of the estate, they never have to pay taxes on that appreciation. And so most people keep the assets until they give to their beneficiary and they sell it and they don't pay any taxes. So that's a great benefit. And that's going to be 11.2 million per person. That's going to be 22.4 million for married couple. So that would exclude most U.S. taxpayers from estate and gift tax. But like I said, you can't plan for that because it's sunsets, and so it's good, sort of. Alternative minimum tax. Alternative minimum tax for individual is still around. That's the reason why we told some taxpayers not to prepay some of our clients not to prepay the property taxes and state income tax, because under the alternative minimum tax, state and local taxes are not deductible. So that is and then the exemption has gone up. And then the phase out of the exemption has gone up also. So less people will be subject to alternative minimum tax. So that's why it's good. Business tax reform. And we will discuss a selected provision because we selected the provisions that are most applicable to our clients. This is something that we heard a lot about. The C corporate tax rate has decreased to 21%. All corporations starts out as a C corporation. On certain corporation, it may be more beneficial to be an S corporation. And by making an election with the IRS, a C corporation can become an S corporation. The difference between C corporation and S corporation is that C corporations are subject to 2 layers of taxation. Once at the corporate level, and then again at the shareholder level. In contrast, S corporation and other pass-through entities are subject to single layer of taxation. The shareholder, partners, members, or other pass-through entities are allocated income, and they pay taxes in their individual tax returns. Most closely held businesses run their business as S corp or other pass-through entities, rather than as C corporation. The reason is that the shareholders want to have the use of profits earned by the corporation. This is different for large corporations, where profits are usually reinvested in the business. As such, not all of the profit of C corporation would be subject to second layer of taxation. However, if you like to keep the profits in the corporation to reinvest in the business, then a C corporation may be a way to go. And time has never been better to be a C corporation. Since the C corporate tax rate has gone down. And it's 21% from a high of 35% in 2017. However, that's flat 21%. So for small corporations, it may actually be detrimental to be a C corporation because they don't get that graduated tax rate of a lower tax rate. So it's flat 21%. Now, care should be taken in turning your business into a C corporation, since S corporation or other pass-through entities may still be better. And this is especially true if you get the pass-through business income deduction. Oh, so we just missed the A, B, C here. Okay. The comparison of we will compare the new corporate C tax rate versus new pass-through business incomes tax rate to see what it would be like in 2018 to have a C corporation versus pass-through entity. This chart, again, is from Tax Foundation. And this bar graph turned on its side shows the corporate tax rates of industrialized countries. And in the middle with the blue arrow is a US, which had, and this was put out back in November, that's why it shows current versus proposed. And so current would be somewhere around 40, a little bit over 40%. And then proposed is while they were debating the corporate tax rate, it was going from as high as 27% to around 20%. And they settled on 21% at the end. But you can see US corporations were paying the highest corporate tax rate among all the industrialized countries. The next being highest being 38%, which is France, but that is by far the highest tax rate. At 21%, US is still on the high side of the industrialized country, but the corporations are more competitive. And for this reason, we have recently seen Apple bringing the money back from overseas, because now even if they pay taxes on that interest income or the cash that they bring in, it's going to be taxed at a lower tax rate compared to other countries that they've been parking the money. Even if they have to pay $38 billion in tax, that would be more beneficial for them to bring the money back. So that is happening because of the decrease in tax liability. Also, it's making U.S. company more competitive in the world market. Since most of our clients are closely held businesses, we need to analyze the tax implication at the owner's level, with the objective of owners wanting to enjoy the profit and not keeping the money trapped in the business. With that objective, we have presented our comparison between C corporation and pass-through entities, which are sole proprietorship, S corporation, LLCs, and partnerships. Although the actual analysis of pass-through versus C corporation is much more complicated and detailed than presented here, this presentation provides a simple overview to relay the concept. Starting with a taxable income of 100%, we will see the percent of taxable income which will be left in the hands of the owner. The pass-through, we have assumed that the pass-through would qualify for 20% pass-through business income deduction, lowering the effective tax rate to 30%. If we look at the C corporation, even if we have 21% reduced tax rate, if the corporation's profit is distributed to the shareholders, the effective tax rate is 41% if the shareholders are planning to withdraw the profit for their enjoyment. So as you can see, even if you don't get the pass-through business income deduction, the effective tax rate is 37%. And comparing that to a C corporation, we still see 4% difference. To some clients, it may make sense because they want to deduct the state income tax at the corporate level, because we were talking about the state income tax not being deductible above $10,000. So if you have a flow through, that business profit that flows to your individual income tax return, you have to pay state income tax. However, you're not getting a deduction. So what if you push that income over to the C corporation? In that case, you would get a deduction at the C corporate level. Would the difference be more than 3%? Let's see the implication of that. So in California, the top individual state income tax rate is 13%, corporations 8.84%. Assuming that you get 37%, you're taxed at 37%, then of the 13%, 4.81% is subsidized by the US government. If you put that that state income tax in the corporation, then you would have the federal government subsidize 1.86% of the 8.84%. So your tax rate would be 7% for the state income tax in the C corporation. So we're only looking at the less than 2% difference here. So because there's a 4% spread, even if you get 2% benefit, it may not make sense, but then again, it's a case-by-case analysis, and you really have to run the numbers to determine how you would be impacted in this. So what is our recommendation? Our recommendation would be have both pass-through entity and C corporation. And the reason why you want to do that is you want to keep the pass-through entity up to the level that's not limited. So the pass-through business income deduction is allowed up to certain income level. So if you're below that, you would get a full 20% deduction. The rest of the profit could be pushed over to a C corporation. Now you have to do 2 tax returns, but by doing so, you would be able to benefit from the pass-through business income deduction. Also, you have to look at the objective of the shareholder, because like I said, the profit that comes out of the C corporation as a dividend is subject to second layer of taxation. So the profit that you're making in a C corporation, you want to make sure that it's funds that you could afford to keep it for working capital needs. in a C corporation, and you don't want to pay the second layer of taxation. So that is a consideration in determining how much profit you want to put in the C corp. On the profits that's in the pass through, those are definitely something that the owner want to keep to pull out for their enjoyment. So combination of the two seems to be the way to go for 2018 to 2025. So married filing joint, the income level is 315,000. Actually, you have another 100,000, but starting to 315,000, you need to keep a close eye on it. For all of the taxpayers, that level is actually lower. For C corporation, unlimited amount that you can put in the profit. However, the money have to be, if you want to avoid a second layer of taxation, that money has to stay in the corporation. So that'll be the money that you need for the working capital needs. If you accumulate funds above the working capital needs, there is a accumulated income tax that's a penalty for keeping too much profit in the corporation and not declaring dividends. So you need to be careful of that too in a C corporation. Equipment purchases, we see the tax rate is a little bit higher at the business level because 21% corporate level, assuming that we don't factor in the second layer of tax, that's 21% at the C corporation level versus 37% for the pass-throughs. You'd be better off taking that 37% tax benefit at the pass-through entity. Same thing with expenses. You want to maximize to maintain $315,000 of profit, C corporation as needed. On pass-through the income, you want to defer as much income until 2026, keeping your income less than $315,000 for married filing joint, lower for all other taxpayers, C corporation as needed. Losses with limited involvement by owners. This would actually prevent you from getting the small business tax reform benefits. So you may want to minimize losses as much as possible, but C corporation doesn't have that limit. So that's something that you need to play between the two corporations if you have both of them. Interest is limited to 30% for both C corporation and pass-throughs. And time horizon is that the pass-through business income deduction sunsets on January 1st, 2026. C corporation, there's no restrictions. So you could do more long-term planning with a C corp, but for the pass-through, you have to keep an eye on the sunset provisions of the tax law. I'll live this up for a little bit longer for people to make this their knowledge, and then I'll move on. Bonus depreciation. You will see a lot of provisions in the business tax reform benefiting equipment or heavy machinery investments. And there's a rationale behind that. The Congress wants to encourage manufacturing jobs coming back to the U.S. So to have a manufacturing jobs, you have to invest in machineries and equipments. And so there's a great deal of benefit that's provided to bonus depreciation, which gives you up to 100% depreciation of the equipments that you purchase and place in service in the first year that you place it in service. In 2017, that bonus depreciation was 50% of the new equipment. Starting 2018, new and used equipment qualify for the 100% bonus depreciation. So it's been expanded to include used equipment. And so that's starting September 28, 2017. So This provision, the bonus depreciation and Section 179, benefits 2017 for equipments placed in service from September 28, 2017. So the bonus depreciation has gone up to 100%, used to be 50%. Used to be only new equipment qualify, but now used equipment also qualify. Section 179. Section 179 in excuse me, in 2017, up to $510,000 could be expensed in the year that you place it in service. Starting 2018, new and used equipment can be expensed up to $1 million. And that sunsets in January 1st, 2016. Starting 2018, only up to 30% of adjusted taxable income can be deducted in a business for business interest. And so that's a bad thing for businesses because they're put a limitation on highly leveraged companies. Starting 2018, business losses are allowed up to $500,000 for married filing joint and $250,000 for all other taxpayers. The losses in excess of the $500,000 and $250,000 can be carried forward as a net operating loss. Starting 2018, significant tax benefits are provided for small business in terms of accounting methods such as cash basis of accounting, no need to account for inventory, no need to use percent completion method for contractors, and small businesses are defined as having $25 million in gross receipts. So we will see a significant amount of deduction through the change in accounting methods for small businesses. And so this is something that has to be analyzed during the summer of 2018. Starting 2018, net operating losses, or NOL, can only be deducted up to 80% of the taxable income. In 2017, NOL could be used as much as there's taxable income. So you could zero out the taxable income, but starting 2018, you still have to pay 20% of your taxable income you have to pay taxes on 20% of your taxable income. Qualified improvements. Qualified improvements are improvements to real estate, which are treated like close to equipment. So they would get a shorter life of depreciation. So real estate, for commercial real estate, you're looking at 39 years depreciation. You could actually get it as short as 15 years for qualified real estate improvements. And there was three different categories of the real estate improvements in 2017 that has been consolidated into qualified improvement. But due to haste in passing the tax reform, real estate improvements or qualified improvements is mistakenly left at 39 years. So we would need a technical correction. And most tax professionals expect that. And if you look at the legislative languages, the intent of the Congress was to give 15 years for the qualified improvement, but the actual wording is left at 39 years. So more to come on the qualified improvements. Like-kind exchange. Starting 2018, only real estate qualify for like-kind exchange. So that actually going to create complication for real estate investors, especially when they have gone through something called cost segregation study. And cost segregation study is an engineering study to break up the building into components, to identify components which are subject to shorter life of depreciation. And by doing so, you decrease the amount of the real estate to be depreciated under 39 years. Because you have done that, and then you cannot separate out those components from the building when you sell it, it's going to create some issues for the like-kind exchange. And so we would need some guidance in this area. So more to come. Tax shelters. It is not what you think it is. If your business falls into tax shelter classification, your business would not get the benefit of small business tax reforms. And tax shelters are any pass-through entities generating loss with more than 35% of owners having limited involvement in the business. If you are considered to be a tax shelter from 2018 to 2025, then that small business tax reform benefits may not be available to you. Starting 2018, entertainment expenses are not deductible. Now, entertainment expense is actually a very important part of running a business, because business is a relationship, and the relationship that you build with the customers, with the vendors, with the colleagues, are all important part of running a business. However, the government is saying that they would not subsidize those activities. They could still be paid to the corporation, but not deductible for federal tax purposes. Now we will enter the detailed discussion of selected provisions. And there's one more question here. Okay, the question by Chris again is, please explain why there is a wide variance in the categories. Some receive minimal and some up to 17% for those who itemize. That I am not sure. I mean, we haven't done that detailed analysis. One thing that I did find is that among those who have itemized, especially those employees who have taken unreimbursed business expenses, they were able to deduct those expenses above 2% of AGI, and IRS love to audit those type of deductions. And because under the 2018 law, that's no longer deductible, you may see less of a tax decrease on some, because especially those people who have taken miscellaneous itemized deduction in 2017 and they don't get that, the saving may not be as big because they were getting that maximum benefit before, because you're not getting that miscellaneous deduction in 2018. Even with the tax rate changes and brackets moving up, it's not enough to compensate for the loss of the miscellaneous itemized deduction. So you really have to look at this on a case-by-case study. But we are also looking at the tax returns that are actually being completed up to this point. And the findings are pretty consistent to what we have analyzed in January. But we will look at it a little bit more closely at the end of the tax season to see if what we have computed in January is in fact the case when we look at the tax returns that were completed by April 17. So we will look at that, and we would make our findings known to you at that time. Hopefully that answers your question. So now we will enter the detailed discussion of selected provision. If you're like most clients, you will probably sign off about now, as you know that our firm have you covered for the tax reform. But if you are an engineer type, and we have many such clients, we will go through the selected provisions, providing background information so that you could put them in perspective. We are recording this webinar and we will post it on our website. So please visit www.ksgallp.com or www.anderson-tax.com if you wish to listen to them at your leisure. Individual tax rate. The top rate has gone down from 39.6% to 37%. The brackets where the 39% would start for married filing joint in 2017 was 470,400. For married filing joint in 2018 and 2025 would be 600,000. So the bracket has moved up for the top rates, and then the rates has come down. So that's why you see the benefit for the taxpayers. The mid rates also has gone down from 33% to 32%. And in 2017, married filing joint with $233,000, $250,000. Income above that would be subject to 33% tax rate. That has moved up to $315,000 in 2018. If you look at the tax rates, the lowest tax rate is about the same. Excuse me. So the bottom rate is stay the same, 10% each on both sides. The top rate in 2007, excuse me, the 15% in 2017 has come down to 12%. 25% has come down to 22%. 28% has come down to 24%. 33% has come down to 32%. 39% has come, 39.6% has come down to 37%. So all the rates have come down. The bracket has moved up on all of them. So the taxpayers are getting benefit for lower tax rate. Capital gains tax rate has stayed the same, but the threshold amount to increase the capital gains tax rate from 0 to 15, from 15 to 20%, have moved up. Standard deduction has almost doubled, not quite doubled, for single, head of household, and married filing joint. Person exemption in 2017, for each person in your household, you were able to get $4,050 deduction. And for high income earners, the $4,050 would be reduced by 2% for each $2,500 exceeding that income level. Starting 2018 to 2025, the person exemption has been suspended. Child tax credit was $1,000 up to age 17. So that's under age 17. That has moved up to $2,000. And the phase out, so if your income is above $110,000 for married filing joint, that $1,000 would be reduced. For each $1,000, you would have $50 decrease of the credit. That has been moved up to $400,000 in 2018 to 2025. So more people will be able to qualify for the $2,000 child tax credit. Also, there's a $500 non-refundable credit for qualifying dependents other than qualifying children. That's family tax credit. And so if you have children above age 16, or if you have a dependent such as your parents, you would get $500 non-refundable credit, and that's called family tax credit for 2018 to 2025. 529 plans is widely used to pay for college and university tuition. And the way this is done is the parents would lump up 5 years worth of the gift amount, and the gift amount for 2018 is $15,000, was $14,000 in 2017. And so if you're looking at to do a 529 plan, you could actually contribute up to 5 years worth of $15,000 or $75,000 per child, per parent. So if you're married, both of the parents could contribute. That's $150,000 that could be contributed to the 529 plan. So why do people do this? So if you put the money in when the child was 5 years old, and then you have 17, maybe 14 to 15 years that you could invest the money. And under the rule of 72, which means if you earn 7% return in 10 years, you're going to double the money. So you could double the money. So that could become $300,000 or more by the time the kid goes to school. So that's going to pay for most tuition. So that's why the parents put that money aside, and by lumping that money for 5 years worth of gift, they could fund the tuition for the child, and that's for each child. So if you have 3 children, then you could actually do 3 times 150,000. So that's why people put money in 529 plans, and people invest and have it grow tax free, because what you put in today is going to be far greater in the future. Otherwise, people wouldn't invest. Overall limitation on itemized deduction, PEAS limitation, that has been suspended, and that actually hurts. That actually is a good thing for the taxpayer, because for the high income earners, they stand to lose up to 20% of itemized deduction. And so without that, those in the higher income tax bracket actually benefit, because more of their itemized deduction could be deductible. Although state and local tax is limited to 10,000, they still could contribute more to the charity. You know, some people say, I don't want to work because the next dollar that I'm making is going to go all to the government. If that's the way you feel, then maybe you should give it to a charity, and that's going to lower your income, and you don't have to pay tax on it, and you feel good about it too, and you make money. The government doesn't take 100% of your income, so that thinking probably is not correct, but many clients have said that to me. Mortgage and home equity interest deduction. Up to $1 million in acquisition mortgage. Acquisition mortgage is what you paid to buy your house. So if you bought your house 30 years ago and you bought it for $70,000 and it's worth $1 million today, and in the process you've been refinancing and taking that money out, and you now have a $500,000 of mortgage. Your acquisition mortgage is $70,000. That's what you paid originally. Now, if you have used the refinanced funds to make improvements to your house, then that could count as your acquisition mortgage. And plus $100,000 in home equity loans, but something to keep an eye on. But $1 million limit has gone down to $750,000 starting 2018 to 2025. Also, home equity loan related interest are no longer deductible. So if you have home equity loan to fund your business, you could still deduct it as part of the business, but you have to do a tracing of that fund. Also, the mortgages in place on or before December 15, 2017 are grandfathered, meaning that you still could use $1 million acquisition mortgage limit. However, the $100,000 home equity loan interest deduction is not deductible starting 18 to 2025. State and local taxes, $10,000 limit for combined state and local income, property, and sales tax deduction. However, if you have property and sales tax related trade or business, there is no limitation. You could deduct it against those activity. Charitable contribution, you could give up to 60% of the AGI, used to be 50%. In the past, if you donated to your school and you received sports tickets of school sports event, you could still deduct 80% of it, of the contribution. Starting 2018 to 2025, that deduction has been suspended. Alimony. We were talking about the alimony starting 2019. For 2017 and 2018, you still could deduct the alimony that you paid as a deduction, and the receiving spouse has to pick it up as income. However, if you get a call from your ex during 2018 and wanting to modify the divorce agreement, please keep in mind, if you do that, you would not be able to get a deduction for the alimony that you pay, and the receiving spouse would not have to pick it up as income. So that's the reason why they would be calling. Moving expense, if you move to start a new job, and that's 50 miles away from the old home to from old work, then you could deduct those expenses, even if you don't itemize. But that's been suspended starting 2018 to 2025. Um, the miscellaneous itemized deduction, these are expenses for production or collection of income exceeding 2% of AGI, and that includes unreimbursed employee business expenses. That no longer is deductible for 2018 to 2025. Moving expense reimbursement was excluded from income for the employee starting 2018 to 2025. That's income to the employee. The exception is active military personnel. The Obamacare penalty is still there for 2017 and 2018, so don't give up your health insurance just yet. 2019 and subsequent years, the individual share responsibility or Obamacare penalty is reduced to zero. But we'll have to wait and see what happens with the midterm election with this item. The state and gift taxes is imposed at 40% of the estate value. The annual gift exclusion is $14,000. The lifetime exemption was $5.49 million in 2017, and that has been moved up to $11.2 million starting 2018 to 2025. The gift exclusion is $15,000. So if you're above $15,000 per year in annual gift that you're making, that's per recipient, per donor, then it's going to eat up your $11.2 million of the lifetime exemption. So a lot of people are going to be gifting from 2018 to 2025 to, if their estate is above 11.2 million, and for a married couple, it's going to be 22.4 million. For those large estate, they would try to gift their estate to their children or to their grandchildren to lower their estate to less than 11.2 million. In fact, they would try to lower it to less than 5 million because it's set to reduce down to 5 million in 2026, indexed for inflation. So it's going to be above 5 million, but it's going to be indexed for inflation. So they want to reduce their estate to lower to less than that amount during 2018 to 2025. So that would be a planning. But it has a limited benefit because people don't plan to die. So you can't really do a long-term planning with this type of benefit. Alternative minimum tax is still there. Although the exemption amount has gone up for married filing joint, was $78,750 for 2017. It's now $109,400. And the phase out where this exemption amount would start decrease has gone up from $150,000 in 2017 for married filing joint to $1 million. And for all our taxpayers, $500,000. So less people are going to be subject to AMT for 2018 to 2025. So that would benefit high income earners. The business tax reform, lowering a corporate tax rate. We talked about the rates coming down to 21%, pass-through business income deduction, benefits for small businesses, disallowance of entertainment expenses, losses for business losses, and interest on high leverage deals. Tax rates in 2017, you have 4 graduated tax rate, 15, 25, 34, and 35%. Most of our clients are around 34% tax rate for C corporation. Very few of our clients, in fact, none of our clients are over 10 million because most closely held businesses are in this range. But that has actually changed to flat 21%. So for those clients who were already in that 15 to 25% bracket tax rate, they would actually be worse off with the tax reform because actually 15%, 25 would be 21, but 15% taxpayers would actually move up to 21 because it's a flat tax rate. Personal service corporation. Personal service corporations are corporations, C corporations, where the main business would be providing services such as doctors, attorneys, accountants, engineers, architects, and those were subject to 35% tax rate. That's the highest tax rate for the corporation. That has come down to 21% flat tax rate. So that is a good thing for personal service corporation. AMT was 20% of the AMT income. That was the tax rate for the AMT. That has been repealed, and this is actually permanent. So we talked about temporary sunsetting January 1st, 2026. There are some permanent changes, and corporate tax rate is a permanent change. Because the tax rates have come down, the C corporation deduction has come down also from 70% to 65%, 80% to 70%. And the reason why there's a benefit in this is because if you receive dividend from another C corporation, then because that dividend also has to come out to the shareholders, you have 3 layers of taxation now. And if you have layers of corporation underneath that, then you have quadruple, maybe 5 times the 5 levels of taxation. So to lessen that impact, if you receive dividend from another C corporation, you get a deduction. So if you own more than 20% of the C corporation, then you get a 70% deduction in 2018. And if you own less than 20%, then you get 65%. So that would lessen the impact of having to pay different layer of taxation. Pass-through business income deduction is 20% of qualified business income by owners of pass-throughs. And pass-throughs are sole proprietorship, partnership, as corporation. This is something new. We didn't have that in 2017. So what is a qualified business income? Qualified business income is net amount of qualified item of income, gain, deduction, and loss with respect to qualified traded business. And this is how the tax law is written. So you just have to go through layers. It's like peeling the onions, and it does make you cry. Qualified trader business is any trader business of the taxpayer other than specified service trader business or business of being an employee. So now we have to see what's specified service trader business, or any business other than service business, right? So let's take a look at what that is. Specified service trader business is health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, where the principal asset is reputation or skill of one or more of its employees. Something interesting is that engineering and architectural services are specifically excluded. And we know that in the House version of the tax reform, engineering and architectural services were included. But in the conference report, when they were reconciling the House bill and the Senate bill, engineering and architectural services were specifically excluded. So I think that's by design. So one way to interpret that is they would think that principal assets and reputation of skill of one or more of its employees doesn't apply to engineering and architectural services. Or I would think that they just had a better lobbying firms working for them. So if you are above the applicable threshold amount, and this is important because all businesses, if you are between the applicable taxable income or the threshold amount and 100,000 for married filing joint and 50,000 for all other taxpayers, you get partial deduction. And if you're above 415,000 and then 207,500, you would get a limit. There's a limitation that's imposed. So let's take a look at those limitations. So if you're above applicable threshold amount plus 100,000 for married filing joint, 50,000 for all other taxpayers. If you're a service business, you don't get any pass-through business income deduction. All other businesses, the pass-through business income deduction is limited to greater of 50% of W-2 wages or 25% of W-2 wages plus 2.5% of unadjusted basis of all qualified properties. So let's take a look at the definition of qualified properties. Qualified properties are equipments. These are less than 10 years of depreciable life, held or used in the qualified trade or business. So these are equipments or heavy machineries. Bonus depreciation. This is applicable for equipment placed in service after September 27, 2017, you get 100% bonus depreciation. Used to be 50. That amount is good until December 31st, 2022, when it's going to go down to 80% in 2023, 60% in 2024, 40% in 2025. And used means taxpayers have not previously used the property and bought it used. So if you have leased that equipment and then you buy that equipment at the end of the lease term, that would not be considered to be used. Section 179 expensing, up to in 2017, up to $510,000, you could expense it in the year placed in service, as long as the assets placed in service is less than $2 million or less. Starting in 2018 to 2025, that's going to go up to $1 million. $2 million is going to increase to $2.5 million, and then new and used tangible personal property qualify. And you have to make an election to take that expensing. Business interest is limited to business interest income plus 30% of adjusted taxable income plus floor plan financing. Business interest income applies to banks and finance companies, so it doesn't apply to most businesses. Floor plan financing are for dealers of big machineries, such as cars, could be the manufacturer or equipment dealers. They have to finance their inventory through floor plan financing. So they actually could go up on amount of the interest, business interest that you could deduct. But for most businesses, you're stuck with 30% of adjusted taxable income. For the interest that's above that 30%, you can carry that forward. However, if you're a small business, you're not subject to that 30% limitation. Also, if you're a real estate business, and in Southern California, where in most real estate is highly leveraged, and your interest could be above 30% of adjusted taxable income. And so you could elect to be excluded from that limitation. However, it comes at a cost, and that election is irrevocable. So that has to be made very carefully. But you need to analyze the numbers to determine the full implication. Starting 2018 to 2025, business losses for merit filing joint. If the losses exceeds other income, it's limited to $500,000, and that's for merit filing joint. For other taxpayers, it's $250,000. So during 2018 to 2025, you need to really look at those businesses that's generating losses and then run the numbers to see the full implication. Small business reform. In 2017, if a business had less than $5 million in gross receipts, and then it wasn't a corporation or a partnership that has corporate partner, could use cash basis accounting. That $5 million has been increased to $25 million, unless you're considered to be tax shelter, and we'll talk about that. Also, the qualified personal service corporations are generally permitted to use cash method of accounting, regardless of gross receipts. Commonly controlled business could aggregate. So what that means is that businesses have created many corporations so that they can benefit from that $5 million limit on the average gross receipts. So if you have many commonly controlled businesses, the IRS would aggregate all of them together to see whether you are under that $5 million threshold. So that's where the aggregation comes in. In any case, it's moved up to $5 million starting 2018. Small business reform, also uniform capitalization. This is something that came about at the end of at the end of 1980s, where they capitalized a portion of the inventory for manufacturers and resellers. a portion of the selling, general, and administrative expenses. So if you increase the inventory, you also increase taxable income. And so that applied to resellers and manufacturers. But if your gross receipt is less than 10 million, then you don't have to account for uniform capitalization. Starting 2018 to 2025, that 10 million has been moved up to 25 million. Inventory, if you have an inventory, that means even if you paid for it, you have to keep it as an asset. You cannot expense it. And in the past, again, the $10 million gross receipts, less than $10 million gross receipts, then you could use, you don't have to account for inventory, except for corporations and partnership with corporate partner. Also, if you had an applicable financial statement, these are the financial statements that's provided to a third party, such as banks, then you have to use the accounting method used in the financial statement. And this is important because most manufacturers, they finance their operation with the bank loans, and same thing with the resellers. And so they provide financial statement to the banks. In that case, they could not use cash basis and expense inventory. They actually have to be on accrual basis and account for inventory. And so that was there in 2017. That has not changed. However, the threshold amount has gone up to 25 million. Contractors, less than 10 million in gross receipts, didn't have to use percent completion method, which allowed the contractors to delay recognizing income. So if you defer income, they're better off tax-wise. But that's only up to $10 million in gross receipts. That has moved up to 25 million. Again, applicable financial statements, if they provided financial statements to a bonding company or to the banks, they were still limited to using the percent completion method. The 30% limit on business interest deduction, small businesses do not have to be limited by that rule, and that's for $25 million, less than $25 million in gross receipts. So it's a benefit for small business to be to have that cash basis accounting, plus not having the limitation of 30% business interest deduction. However, if you're considered to be tax sheltered, then you don't get that benefit. Net operating loss deduction, and this is something that troubled many taxpayers in the past. Net operating losses, NOL, has to be carried back 2 years and then carry forward 20 years. So you have to carry it back. But you could make an election not to carry the NOL back and just carry the NOL forward. We have seen taxpayers, and these are the new clients coming to us, where they have not carried the losses back and they thought they could carry that forward. But because the rule says you have to carry it back 2 years first, and they find out about this like 5 years after the loss was incurred, they cannot go back to 2 years back to amend the returns because the statute of limitation has expired. So they stand to lose that NOL, plus they stand to lose the refunds they would have gotten. So the Congress has changed so that you no longer have to carry it back, but only carry it forward. And then the 20-year limitation, you can carry it forward indefinitely. However, the farmers could still carry the losses back. In the past, NOL could be used 100% against income if there was adequate income. Now, only 80% could be used against taxable income. So you still have to pay tax on 20% of a taxable income. Qualified improvements. In 2017, there were 3 categories. They call Qualified Retail Improvement Property, QRIP, Qualified Leasehold Improvement Property, QLIP, Qualified Restaurant Property, QRP, and they were subject to 15-year depreciable life. That's better than 39 years for commercial property. And they could get bonus depreciation in Section 179. So that's the benefit of being these categories of real estate improvements. That has been consolidated into Qualified Improvement Property, which replaces QRIP, QLIP, and QRP. However, it should be 15 years depreciable life. But due to haste in passing the law, QIP is written in as 39-year depreciable life. So we will need technical correction on this. Like an exchange, this is especially the case for real estate investors. They normally do like-kind exchange until they die. The reason for that is if they delay gain on sale of a real estate until they die, the beneficiary of the estate received the property at a step-up value. And when they get a step-up in value, all the gains that has been deferred gets wiped off. So they never have to pay tax on that deferred gain. So if you can delay it as long as possible, that's the way to go. And there's a term for that. It's called swap until you drop. And that's an actual term people use. And so they would do like-kind exchange until they die. And then they give it to their heirs, and they don't have to pay any taxes because their cost basis is the fair market value of the property that they received on the date of death. However, starting 2018 to 2025, there's going to be a complication because the like-kind exchange is now limited to real property. And so for those who have gone through cost segregation study, that's something that needs to be analyzed to see the implication. Tax shelter. A tax shelter is any partnership or any entity other than C corporation if more than 35% of the losses during the period are allocated to limited partners or limited entrepreneurs. So if you are considered to be a tax shelter, you do not get the benefit of small business tax benefit. So that's something that needs to be watched and make sure you don't accidentally fall into. Entertainment expenses are not deductible for 2018 to 2025. So it's a bad thing for businesses. More guidance is needed. Stay tuned for things to come. We will have technical corrections, IRS regulations, IRS revenue rulings, IRS revenue procedures, IRS notices, IRS announcements. So these are the things that are going to come, and we need to analyze it. Most of all, we need to run the numbers to your specific case. So discuss with your tax preparer and see how you will be impacted. And most likely we'll have to do that during the summertime because we won't have time to do that during the year, during the tax season. But ask us, and we'll be more than happy to run the numbers for you after the tax season. A takeaway. Ask your tax preparer to run 2018 analysis to see how you will be impacted in 2018 and beyond. So we have a simplified analysis that we could run from our tax program to see what you would look like. But that doesn't include the business tax reform provisions. So that we need to run it separately. Evaluate the benefits of converting to C corporation. Consider pass-through business income deduction. Invest in depreciable assets for your business. Review depreciation method of assets placed in service from 2018, actually from September 2017 and subsequent years. Consider changing to cash method of accounting. Limit entertainment expenses. Review employee compensation arrangements. Evaluate interest expense deduction, both business and personal. The recording of this webinar will be put on our website, www.ksgallp.com or anderson-tax.com. And you can play it back at your leisure. And you should contact your tax preparer to see how the provisions of the tax reform affect your tax situation. At this point, I will take questions if you have any questions, you can type them. Otherwise, I'll wait for about 2 or 3 minutes, and then we'll end the